All right, let's talk about zero-day options. You might have heard them called zero DTEs. This is Wall Street's $1 trillion daily gamble, and it has absolutely exploded in popularity. So what are these things? Why have they completely taken over the market? And are they a ticking time bomb just waiting to go off? That's what we're going to unpack.
And wow, this quote really gets straight to the point, doesn't it? Wall Street's new casino. It begs the question, is this the next big financial innovation, or is it basically a giant gambling hall? The crazy thing is, it might just be both. And that tension is exactly why we need to wrap our heads around this. So let's talk scale for a second. How big are we talking here? $1 trillion. That's the amount of money, on average, that's being traded in these things every single day. Let that sink in. It's an absolutely staggering number, all riding on contracts that literally just, poof, disappear in less than 24 hours. But what's maybe even crazier is how fast this all happened. I mean, just a couple of years ago, these zero DTEs were this tiny niche product that almost nobody was paying attention to. And now, well, take a look. They are the market. They make up over 60% of all S&P 500 options trading volume. They didn't just join the party. They completely took it over. So, to really get what's going on here, both the risks and the rewards, we have to understand how these things actually work. And that means we need to take a quick peek into the world of options trading, specifically to talk about two concepts known as the Greeks. First up is theta. Now, don't let the name intimidate you. It's really just a fancy term for time decay. You see, all options lose value as time ticks by. But for a zero-day option, which expires in just a few hours, that decay is on hyperspeed. The analogy of a rapidly melting ice cube is perfect. Its value is just bleeding out, minute by minute. And on the complete flip side of that, you've got gamma. If theta is the brakes, gamma is the accelerator. It measures how sensitive an option is to the market moving up or down. And with these zero DTEs, gamma is just off the charts. It's like a hair trigger. A tiny, tiny little wiggle in the S&P 500 can cause the value of these things to absolutely explode, turning pennies into dollars in the blink of an eye. Okay, so let's put this together. You have theta, the melting ice cube, constantly pulling the value down. And you have gamma, the hair trigger accelerator, ready to make it shoot to the moon. Now, what happens when you mix those two volatile ingredients together at a trillion-dollar scale? You get the potential for a really dangerous feedback loop that Wall Street calls a gamma squeeze. Right, so you might be thinking, okay, that sounds risky for the people trading them, but why should I care? And that is the million-dollar, or I guess trillion-dollar question. How does this super sensitive hair trigger setup become a problem for the entire market? How does it create systemic risk? Well, it's all about this feedback loop. Here's how it goes down. It starts when a massive wave of people buy these options. Then the market moves just a little bit, and those options start to look profitable. Now the big Wall Street dealers who sold the options, they have to protect themselves. They have to hedge, so they're forced to buy or sell stocks to cover their position. But here's the kicker. That huge wave of buying or selling from the dealers pushes the market even further in that same direction, which means they have to hedge even more. You see how this can spiral? It amplifies a small move into a really big one. And this isn't just some abstract textbook theory. The real danger here is that a sudden shock, a surprise headline or some unexpected economic data, could kick this feedback loop into overdrive. And if that happens, a normal, healthy 2% market dip could escalate into a severe intraday flash crash. The speed of it all is what's so potentially dangerous. So who exactly is driving this trillion-dollar daily machine? It turns out it's a fascinating story of two very different groups with two very different motivations. It's a real tale of two cities. And you can see the split pretty clearly here. In one corner, you have retail traders. For a lot of them, this is about making speculative bets. These options are like low-cost lottery tickets, a way to gamble on the market's direction on any given day. But in the other corner, you have the big institutions, the hedge funds and massive asset managers. They aren't gambling. They're using these things like a surgeon's scalpel for incredibly precise risk management. They can hedge their portfolio against a specific event for just a few hours without having to take on any risk overnight. Same tool, completely different ballgame. Okay, so let's pull all these threads together. We've got the instrument, we've got the danger, and we know who the players are. So what does it all add up to? What's the final verdict for a market so dominated by these incredibly short-lived contracts? One of the sources we looked at for this explainer summed it up in a really powerful way. What we're seeing is the hyper-financialization of time itself.
Just think about that for a second. We used to think about investing in terms of years, maybe months. Now we've compressed that entire horizon down to a few hours or even minutes. So here's the bottom line. This is absolutely a double-edged sword. On the one hand, yeah, it creates a ton of liquidity and gives institutions a tool for incredibly precise hedging. But the other side of that sword, it introduces a whole new level of fragility. The market might not be more volatile from one day to the next, but the potential for huge, violent swings within a single day gets cranked way, way up. So, as we get to the final bell on this topic, what's the one big idea we should really walk away with? What does this massive shift in the market structure truly mean? It really leaves us with a pretty wild question to think about, doesn't it? We've built this unbelievably massive, fast, complex trillion-dollar system, but is its foundation now built on contracts that literally just vanish into thin air at 4 p.m. every day? That's the new reality, and it's a question regulators and really all of us are going to have to grapple with. Thanks for joining us for this explainer.